Welcome to Outside the Dollar. I'm Elena Reyes, and today's episode is built around a single question. What does it actually mean for your money when the financial architecture around you starts to shift? Here's a number worth sitting with. According to the Economic Times, central banks now hold nearly $4 trillion in gold, slightly above their holdings of U.S. Treasuries. Gold has overtaken Treasuries as the world's largest reserve asset for the first time in roughly 30 years. That is not a small move, and it didn't happen overnight. Before we get into what's driving that structural shift, I want to start somewhere more immediate. Right now, gold is edging higher on the back of U.S.-Iran tensions and what a Fast Company piece from this past weekend describes as inflation spreading through the economy beyond just gas prices. Gasoline is above $4 a gallon, and the broader price data is looking stickier than most people expected. Geopolitical risk has historically been one of the shorter-term drivers of gold. Tensions spike, gold catches a bid, tensions ease, gold gives some of that back. That pattern is well documented, real, but it's noise in the longer arc. A geopolitical headline moves gold for a week. A structural shift in how central banks manage reserves moves it for a decade. The backdrop is what matters here. Real incomes are under pressure. Goldman Sachs flagged this week, per Fortune, that real personal income growth has slowed to a pace rarely seen outside of a recession. Inflation is still biting, and central banks are quietly repositioning their entire reserve strategies. Those three things happening simultaneously is not a coincidence. So the geopolitical headlines are the spark. The structural story has been building underneath for years. That's what this episode is going to stress test. So let's get into what central banks are actually doing, because the numbers from the Economic Times piece tell a specific story. Flip that institutional picture to the household level, and the pressure gets more personal. So the structural backdrop here is federal debt. The number that keeps coming up is this. Publicly held federal debt now sits at roughly 100% of U.S. GDP. David Kelly at J.P. Morgan describes it as going broke slowly. Not a crisis today, a slow erosion of fiscal room. J.P. Morgan lays out 5 broad paths the government has available. None of them are clean, and it's worth walking through each honestly. Path 1 is the status quo. Keep borrowing but at rising cost. As rates stay elevated, interest payments grow. The Congressional Budget Office has been flagging this for years. Interest alone is now one of the largest line items in the federal budget. Path 2 is the optimistic scenario, and J.P. Morgan does acknowledge it. Productivity-led growth. If the economy expands fast enough, the debt-to-GDP ratio stabilizes on its own. Technology, workforce expansion, innovation. The problem is that this requires sustained growth at a pace we haven't consistently hit in decades. And even in the optimistic version, debt doesn't shrink, it just grows more slowly. Path 3 is spending cuts, politically painful, structurally necessary in any real reduction scenario. But here's the thing, the largest spending categories are Social Security, Medicare, Medicaid, and defense. Cutting meaningfully there requires political consensus that hasn't materialized under either party. The math doesn't change with the administration. Path 4 is tax increases. These can raise revenue, but they also reduce disposable income, pressure consumer spending, and create headwinds for markets. Sound familiar? That's the same dynamic Goldman Sachs flagged in the real income data. Households are already feeling a squeeze. Layering additional tax burden onto that environment is complicated. And Path 5 is the one nobody wants to say out loud, a fiscal crisis. If investor confidence in U.S. debt breaks, borrowing costs spike, and the adjustment becomes involuntary. J.P. Morgan frames this as a low-probability scenario, but not a zero-probability one. Central banks reducing their Treasury exposure, as we've seen in the reserve data, doesn't help that calculus. In practice, J.P. Morgan's analysis points to the same conclusion most serious fiscal research does. Real debt reduction almost always requires some combination of spending cuts and tax increases working together, which is why across administrations of both parties, borrowing tends to continue. Assembling that combination politically is hard, sustaining it is harder. So, what do you do with all of this as an investor? The diagnosis across this episode has been consistent. Purchasing power is under pressure at the household level, at the institutional level, and in the structure of sovereign finance itself. That raises a practical question. When the traditional tools are constrained, what role do physical assets play in a portfolio built for the long run? That's where physical gold and silver enter the conversation. Not as a trade, not a bet on any single event or headline. The important thing to understand is that physical metals carry no counterparty risk. A government bond is a promise. A stock is a claim on future earnings. Physical gold is just gold. It can't be printed, it can't be defaulted on, and no issuer can debase it overnight. Investors who hold them typically do so for one reason: long-term purchasing power protection. That's the historical use case. It's also why central banks have been quietly adding to their positions for years. Now, to be direct about what this isn't, prices move. Gold dropped sharply in 2022 even as inflation peaked. No asset is guaranteed. Precious metals aren't right for every investor, and they aren't a substitute for a full financial plan. They belong in a conversation about your time horizon, your risk tolerance, and what role, if any, tangible assets play in your broader portfolio. The structural forces we've examined today aren't going away quietly. That's worth thinking through carefully and ideally with a professional who understands both sides of the ledger. That's a wrap on today's episode. The one thing I want you to carry out of here is this: what central banks are doing with their reserves is a structural signal, and it's worth separating that from the short-term headline noise. We covered a lot of ground: the gold versus Treasuries crossover and what's actually driving it, real income erosion and what it means at the household level. The through line across all of it is purchasing power and where you want to be positioned to protect it over time. If today's conversation got you thinking, visit learcapital.com or call 800-271-2873 to talk with a specialist. And if this episode was useful, a review goes a long way. It genuinely helps more people find the show. Thanks for being here. I'll see you next week.